Okay, picture this. It's 2008. The entire global financial system is absolutely imploding. Lehman Brothers has just vanished, the markets are in a nosedive, and there is just pure panic everywhere. But right in the middle of all that chaos, an even crazier story is unfolding. And it's not at a bank. It's in the German auto industry. It's a story about a bitter family rivalry, some secret financial weapons, and a corporate trap so perfect it would go down in history.
It really does sound like a riddle, doesn't it? I mean, how, at the exact moment the world economy was on its knees, did a car company, Volkswagen of all things, suddenly become the single most valuable company in the world? Bigger than ExxonMobil, bigger than any tech giant? It only lasted for a couple of days, this kind of surreal flash in the middle of a global meltdown. To figure out how this happened, we've got to unravel one of the most audacious, high-stakes corporate gambles of all time.
Just let that number sink in for a second. 296 billion euros. For a brief shining moment, Volkswagen's value just skyrocketed past ExxonMobil, which was the undisputed king at the time. The stock price went from about 200 euros to over 1,000. Now, this wasn't some kind of speculative bubble. Oh no. This was a squeeze. In fact, it's known as the mother of all short squeezes. And it all started with what looked like the safest bet in the entire world.
So to understand the trap, you first have to understand the bait. And in late 2008, the bait was Volkswagen. The global economy was just grinding to a halt. And no industry gets hit harder in a recession than the car industry. People just stop buying cars. It's pretty simple. So for all the smartest hedge funds on the planet, this looks like a golden opportunity, a real sure thing.
Yeah, this quote right here, it just perfectly captures the mood on Wall Street and in London, short-selling Volkswagen, which is really just a fancy way of betting that its stock price is going to go down, was the consensus trade. Everybody was doing it. It felt obvious, totally logical, almost guaranteed. You borrow some shares, you sell them high, and then you just plan to buy them back later when the price crashes. Simple, right? What could possibly go wrong?
Let's just quickly run through their logic, because it made perfect sense. First, you've got a global recession in full swing. Check. Second, demand for cars is absolutely falling off a cliff. Double check. And third, when you looked at VW's stock price compared to other car makers, it just seemed way, way too high. So the hedge funds piled in, borrowing and selling something like 12% of the entire company. They were so sure they were on the right side of this trade. But what they couldn't see was that this wasn't just a financial play. It was a family war.
And this, my friends, is where the story gets really juicy. Because the fate of Volkswagen wasn't being driven by market forces. Nope. It was being driven by a bitter, generations-long rivalry between two sides of the very same family, the Porsche clan and the Piëch clan.
You have to understand these family roots run deep. Ferdinand Porsche, the guy who founded the sports car company, also designed the original Volkswagen Beetle for Hitler's Germany. His grandson was a guy named Ferdinand Piëch, a brilliant but totally ruthless chairman of VW. For decades, these two families had been locked in the simmering power struggle. So what the hedge funds saw as just another overvalued car company was actually the ultimate prize in a family feud that had been going on for generations. So who was behind all this? Meet the architects of the plan. Porsche's CEO, a guy named Wendelin Wiedeking, and his finance chief, Holger Herda. Now, to the public, they were just protecting their business relationship with VW. They put out statement after statement saying, no, we have absolutely no intention of a takeover. But behind the scenes, they were orchestrating one of the most complicated and secretive corporate ambushes ever attempted. So how in the world do you take over a company that's 10 times your size and do it in complete secrecy? Well, you need a secret weapon. You need a financial gadget that lets you fly completely under the radar of the regulators and, even more importantly, all those hedge funds who are betting against you. And this was it. Cash-settled call options. Okay, I know it sounds super complicated, but stick with me. The basic idea is pretty simple. An option gives you the right to buy a stock at a set price down the road. But the key thing here, the absolute genius of it, was that under German law at the time, these specific kinds of options didn't have to be disclosed to the public. They were basically the financial equivalent of an invisibility cloak. Porsche could quietly buy up the rights to huge chunks of Volkswagen stock, and nobody had a clue. Their strategy was a total masterclass in corporate deception, and it had 4 key steps. Number 1, lie to everyone. Constantly deny you have any plans for a takeover. 2, spread your bets. Buy these options from dozens of different banks so no single one of them can see the sheer scale of your plan. 3, use that legal loophole to stay completely invisible. And 4, Well, by the time anyone figures out what you're doing, you've already cornered the entire market. It was brilliant. But then the 2008 crisis got even worse. As Volkswagen stock started to fall with the rest of the market, Porsche's own finances got a little shaky. See, they were using some really complex stuff to fund this whole operation, and the falling stock price was putting them at risk. They were forced to show their hand way sooner than they wanted to. The time had come to spring the trap. So just imagine you're a hedge fund manager on that Sunday. You're sitting at home, you're worried about the global financial apocalypse, but hey, at least you're confident in your VW short position. And then a press release hits your screen. Porsche announces that through a combination of actual shares and these secret options, it now controls 74.1% of Volkswagen. Jaws just dropped all across the financial world. The game had completely and irrevocably changed. So this chart right here, this is the whole ball game. Porsche had locked up 74.1%, but here's the kicker. They weren't the only big owner. The German state of Lower Saxony, where Vivo is based, owned another 20%. And because of a special German law called the Volkswagen Act, that 20% stake gave them veto power. They were never, ever going to sell those shares.
And now for the absolutely brutal math. Let's put the pieces together. Porsche controls 74.1%. The government of Lower Saxony controls 20%. Add that up, and over 94% of Volkswagen's shares are totally locked up. They are not for sale at any price. But remember those hedge funds? They had shorted 12% of the company. That means they were legally obligated to buy back 12% of VW's shares from the tiny pool of available stock, what's called the free float, which was now less than 6%. It was a mathematical impossibility. The trap was set.
So when the market opened on Monday morning, what happened next was just pure, uncut panic. Every single hedge fund manager with a short position realized at the exact same moment that they had to buy back shares that simply did not exist. It was a frantic, desperate, every man for himself scramble for the exits.
I mean, just look at this chart. It's insane. On Friday, the stock was hanging around 210 euros. By Monday, it more than doubled. And by Tuesday, it peaked at an unbelievable 1,005 euros per share. It was basically a vertical line. The more the short sellers tried to buy, the higher the price went, and the bigger their losses got. It was a true financial death spiral.
The financial wreckage was just staggering. Hedge funds lost an estimated $30 billion. One analyst at the time said he had managers on the phone who were literally in tears. But it wasn't just about numbers on a screen. This squeeze had a real and tragic human cost. A German billionaire industrialist named Adolf Merckle, who had made a huge bet against VW, saw his entire empire crumble in a matter of hours. And devastated by the losses, he took his own life. So, Porsche had won, right? They pulled off the perfect financial heist, they crushed the hedge funds, and they were on the verge of finally taking over their giant rival. But in the world of high finance, victory can be a very fragile thing. And this story was about to take one last, truly ironic turn. Here was the fatal flaw in their otherwise brilliant plan. To buy all those shares and all those options, Porsche had borrowed a mountain of money. We're talking over 45 billion euros. And they did it right before the 2008 credit crunch slammed the world's financial system shut. So the very crisis that made their trap so deadly also made their debt impossible to manage. All of a sudden, the banks just weren't lending anymore. And this right here is the ultimate reversal of fortune. The tiny sports car company, now completely drowning in debt, was suddenly vulnerable. The hunter had become the hunted. And their giant, cash-rich target, Volkswagen, saw a once-in-a-lifetime opportunity. In the end, Volkswagen turned the tables completely. They bailed out their would-be conqueror, buying Porsche's iconic car business for about 8 billion euros. The masterminds, Wiedeking and Herta, were unceremoniously fired. And for the next decade, Porsche was buried in lawsuits from hedge funds all around the world, trying to get some of their catastrophic losses back. This quote from a Credit Suisse analyst at the time, I think it just says it all. The Volkswagen short squeeze wasn't just another crazy day on the market. It was a singular event, a financial earthquake that sent shockwaves through the entire system. It was a lesson written in tens of billions of dollars of losses. But when you strip away all the complicated derivatives and the family drama, the real lesson here is pretty timeless. Those hedge funds weren't stupid. They were just looking at the world through a conventional lens. They saw car sales and valuation metrics. What they completely missed were the unseen forces, the family feud, the local politics, the hidden ownership structure that made this anything but a normal stock. It's just a powerful reminder that sometimes the most important question you can ask as an investor is simply, what is everyone else missing? What if the no-brainer bet is actually a perfectly laid trap?